Hey everybody, welcome once again to the Winning Digital Customer Show. I'm Howard Tiersky, and on this show we're always talking about digital transformation, all the ways it can be beneficial to you and your company. Digital transformation really is something that can keep your company relevant and thriving and successful for in the coming years or decades, or as I say in the title of my book, save it to be the antidote to irrelevance, as well as be something that it can be a huge difference for you personally in your career. If you're the person who's leading the charge to transform your company and that turns out to be critical to your company's future success, then you can only assume that's going to be great for your career. But, sometimes we don't always talk about some of the other benefits of digital transformation. Sometimes it seems like you can do anything. Can it help you lose weight? Can it help you stop smoking? I actually don't know about either of those two things. But one thing I have recently learned is that digital transformation can help you save on your taxes. So I wanted to invite a new friend of mine, Michael Galderi, and his associate, Alex, from the Alliant Group, and they'll be joining us today. Hey, guys. And
hey, good morning. Good morning, Howard.
Good morning. Good morning. And I want to introduce you and give you a chance to introduce yourselves. We're going to be talking about something that I have only limited knowledge of, so I am as interested as you are in quizzing these guys about the issue of R&D tax credits. It is, of course, tax day, or it will be tax day tomorrow, at least as of the filming of this episode. Now, of course, the government's given us, I guess, what is it, an extra month on our taxes or something like that?
May 17th, Howard.
Yeah,
May 17th.
So if you forgot that April 15th was tax day, good news, you have an extra month or thereabouts. But we'll consider this. What's that?
The payments are still due. It's kind of.
Oh, the payments are still due.
Yeah, yeah. Very confusing.
Oh, okay. I didn't know that. So, well, actually, I'm glad you said that because it reminds me to say what we want to be talking about today is talking about tax stuff and some legal stuff. And as I always like to say, I'm not a lawyer, despite my parents' ambitions. But so please, consider this directional information. We're trying to be helpful to you, but of course, whatever we talk about today, check with your accountant, check with your lawyer. Don't rely on this. If you're relying on this show as your primary source of legal and accounting advice, you've probably got bigger problems. So, but nevertheless, it may give you something to go talk to your teams about. And I want to get into the nitty gritty of it. But one of the reasons why I think this is so relevant, I want to just highlight that I know a lot of people who watch this show are not accountants. You're not tax people. You're not lawyers. You're people who are trying to drive transformation within your own organization. You may be in marketing. You may be in IT. You may be trying to get projects funded. And the reason I wanted Michael and Alex on the show is not necessarily because we are all fascinated in the details of the tax code, like these guys may be. Thank God that they are, but rather because having some knowledge of this can potentially, I believe, and we'll see as we have this dialogue, be really important to you as you try to go get projects funded. Because what Michael and Alex are going to tell us about is opportunities to get some money back from the government because of certain types of things you may be doing around digital transformation. And because I know that many of you, because I talk to many of you and I work with some of you as part of my company, are always trying to get things funded. And you always have to be able to go in and say, all right, this is what I want to do. I want to upgrade the back-end system, or I want a new app, or I want to deploy this, or whatever you want to do. And it's always going to cost money. And there's always somebody who's asking the question, what's the return on investment? How much is this going to cost? How many incremental customers is this going to get? How much incremental revenue is this going to bring? And those are the right questions to ask. Absolutely. I don't think any of us want to work a place where they just write checks just because someone has an intuition that something would be a good idea. Totally believe in that. But if the reality is that if your company spends $5 million on something and you forecast a certain return on investment, if on top of all that, there's a tax credit that the company can get because of that investment, then that further changes the equation, which is why I wanted you guys to hear from Michael and Alex and hear a little bit about some of these R&D tax credits, because even if there's somebody in your company who does your taxes who would know about this at some point down the process, there may or may not be, but even if there is, you don't want to wait until the end of the year when someone's going, oh, that project we funded, we can get some money back from it. But you want to know it up front, because when you're going to try to get funding, that's potentially going to make your case even stronger. At least that's my hope. That's what I want to quiz these guys about. So that's my intro. That's why we're here talking about this. And by the way, it could also be that you're running a smaller business and you've been spending money on digital transformation, and these guys can show you how, for investments you've already made, you're entitled to money back from the government you're not even asking for. And of course, we all love that, right? And maybe if you can get some of that money, you can use it to fund whatever you want to do next. You can say, hey, I have found out about an R&D tax credit. Let's get this money back and let's put it into the next version of the app or whatever. So those are some of the reasons why I think this is really important, and I want you to stay tuned because I think this is going to be really, really a possible tool that can make a difference for you in your day-to-day. So with that, Michael and Alex, let me let you guys introduce yourselves, what your area of expertise is, and then we'll dive into my many questions about what this all is and how it works.
Sure. So my name is Michael Galdieri. We're with Alliant Group. I'm a technical director with the firm. We're a national tax consultancy. We only deal in a few specific areas of the tax code, and the R&D tax credit is our main credit that we focus on. To date, we've completed over 60,000 R&D studies and returned over $11 billion back to the U.S. economy and our customers. We're really proud of that number because our mission is to strengthen American businesses. So, Alex?
Yeah, thanks, Michael. And I'm, I guess, the technical guy for today's conversation. I've been doing this for a relatively long time, almost 15 years. And I've seen, and probably Howard as well has seen, how the world has moved from a relatively non-digital environment to now being digital, transforming your business, putting the processes that you need in order to just function, right? Now it's just a cost of doing business that's normal. So what I get to do day to day, I've worked with probably about 1,000 clients historically. The majority of those are technology businesses or businesses like we're talking about today that are spending dollars on technology, whether it's a CRM, and it could be something as simple as putting your website on a more effective and efficient platform, adding algorithms that'll allow you to better communicate and track whether or not the data is actually being properly monetized. So hopefully I can provide some clarity from a technical perspective and looking forward to it.
Fantastic. So I'm going to dive in on, that echo just came back. I don't know if you guys need to turn. Oh, well.
Sound great over here.
Okay, I'm hearing an echo. Okay, it's gone now. All right. So I want to dive in on some questions for you guys. And I'm going to start with some basics. Please forgive my ignorance. I know you guys are super expert, and I'm going to start by asking you some questions that are very basic. So I know we're here to talk about R&D tax credits, and my understanding of that is what it means is that if you invest in certain things that can be classified as R&D, and we're going to want to hear from you about what qualifies, you can get some money back from the government. Now, of course, any money that I spend on my business or any business spends should be deductible, presumably, as a business expense. And not to get too in the weeds here, but I guess that's what we're here to do today. A lot of projects that we work on, because they're building new things, wind up being considered capital expenses. And so we have capital expenses, which usually means that they're deducted over the course of 5 years. So a company may spend $10 million this year in cash, but then really they can only deduct from their taxes $2 million a year over the next 5 years, or roughly. I might be oversimplifying. And it depends on what you're building, but that's usually what I've seen. And so that's the nature of it. So already the work that we do when we invest in building things is tax deductible. But I'm assuming you're going to tell us that in addition to those deductions, there's additional things called tax credits, which potentially put even more money in the pockets of businesses. Can you just start off and explain, for those of us that don't think about this very often, what is the difference between a deduction and a tax credit?
Yep. So a deduction is a percentage of your, let's say you spend $1 million and you get a deduction on that $1 million, you would be eligible for only a percentage of that $1 million to be deducted. Whereas a credit is a dollar for dollar reduction. So a credit is about 3 times more powerful than a deduction.
It depends. Usually, yeah. So if you want to think about this in the simplest terms, when you take a deduction, you have to take into effect whatever the tax rate is that you are paying. So for example, example, if you are a C corporation and you deduct $1, under the current rate, it's really worth 21 cents because you're paying 21 cents per dollar as tax. When you are that same C corporation and you get a dollar credit, you take your tax liability after it's all the way calculated through the return, and you get a literal dollar reduction. So in this case, it's almost 5 times more powerful. Now, the fear is right now, obviously, there's been changes in Congress. There's been changes in the presidency. So there's a possibility the tax rates are also going to change. So this is also an effective tax planning tool because R&D is a permanent part of the tax code. I don't know if you knew that, Howard, but we can't treat it as an annuity.
Got it. Got it. And can you take the deduction and the credit, or you have to choose?
Great question.
You unfortunately have to choose, but typically speaking, the credit is far more powerful than the deduction.
Got it.
Most of the time, you would go ahead and take that credit.
I'll take that just one step further. You can do both in the same year, but you can't what's called double dip. Meaning, you can, let's say, of that $2 million example, Howard, you may not be able to deduct $2 million, but 1.5. Another 500 goes to an R&D credit. But when you calculate it through, you're actually getting a significantly higher immediate reduction in total tax in that year. So it tends to be more beneficial.
Got it. And so let's just take our $2 million example. Let's say a company was building a shopping app. You know, let's say they're a retailer and they're going to build a new shopping app and it's going to cost $2 million and they're going to launch it. And of course, that $2 million cost probably has some different types of costs, right? Some of it might be for design and architecture and wireframes. Some of it might be for software they have to purchase. Some of it might be for server hosting. Some of it might be for software developers, etc. I'm sure you're going to say that things are highly dependent on individual situations, but can you give us a broad sense of how much of that $2 million might someone be thinking they might be able to turn into a tax credit?
Sure. Yeah.
So if you want to simplify it, and I think that's kind of the intent today, it could be 100% of it, and it could be 0%. I know that's probably not the answer that you wanted to hear, but it depends on the structure of what you're paying for, and also the people internally in your organization that are assisting with that project. The way that R&D works, when you're looking at some of these digital transformation projects, which are at some level going to be affecting what we call internal use software or different internal softwares that you have, could be literal integration of your existing platforms. So if you are paying a consultant and you're paying them for their time and they're coming in, figuring out what the pain points are, and then implementing that project, and you have a group, it could be leadership, it could be IT, depending on the size of the company, it's going to depend. So you actually are able to look at some of the costs associated with that consultant. So the person that's actually, or the company that's implementing that project. What people do not realize is you're also immediately able to capture some of the labor costs associated with the people internally at your organization that are assisting with that project. There are some concepts in the tax code which allow us to immediately look at those folks which are taking time away from their day-to-day activities and spending them on these projects, not necessarily because they even want to, but because they have to ensure that they work. Right. So in that $2 million example, on average, I would say you can comfortably say 30, 40, 50% usually could be generated towards a credit. Mm-hmm. You would have to have some facts. I think that's fair.
Yeah. And so if I'm following you, let's say you discovered that of the 2 million, 50% could be a credit, which means you'd get 1 million just deducted from your taxes. The other million that couldn't be a credit, you could still deduct in the normal way. Is that right?
That's right.
Right. So you're not trading 20% for 30%. You're trading the half that you can get the credit for, going from 20% to 100%, and then the rest you can't. Well, you still get the deduction like you normally would.
Correct.
Got it. So the scenario that you described sounds like a lot of projects, right? Like we're building a new app, we're hiring some outside people. Just as you said, we have some internal people. But you've also mentioned that, it could be 100%, it could be 50%, it could be 0%. Can you give me a few? And I realize you can't go into every detail of the tax code and all the different possibilities on a show like this. But maybe can you give us a couple representative examples of what, let's say I brought you a situation like this and you asked me a few questions and it turned out, oh man, I'm really sorry, you can't get any tax credit. What would be some common reasons why a project that sounds more or less like what I'm describing would be denied any tax credit? And then what would be an example on the other end where if the stars aligned, you'd actually wind up potentially getting 100%?
So Howard, the tax code itself has evolved and changed, and this credit itself has been around for about 40 years. And when it was initially introduced back in '81 as a part of the Economic Recovery Act, it was very much a lab and patent-based credit, right? With two stipulations. Number one, you had to provide an idea that was new to the world, and then behind it, contemporaneous documentation. But as the 80s and the 90s progressed, Congress saw a lot of technical, skilled, and problem-solving work being offshored for pennies on the dollar. And they said, if we allow this to continue, the United States will become the largest middleman in the world. So they decided to update the R&D tax credit, and they expanded it, which opened it up to about 80 or 90 new industries that had never been touched before, that had never seen the benefit of this. More importantly, it opened it up to the center, to the true heart of America, the small to medium-sized businesses. And they said, you don't have to provide an idea that's new to the world anymore, but you can provide an idea that's new or improved or modified or site-specific, customer-driven, or application-focused to you, the taxpayer. So as you can imagine, when you're talking about projects, right, anything that you're doing that's new, that's technical in nature, could be qualified. So for instance, Alex brought up the example before about implementing a new CRM system, right? All of that labor that would go into that on your side as a company could be considered for this credit. And it's not an all or nothing credit. There will be percentages of people's time that qualify, percentages that don't. And what we've been helping American businesses do is quantify, qualify, and substantiate that. So I know you asked for some specific examples. Alex, do you have any?
Yeah, I can probably answer pretty directly, Howard. So the R&D lives either on the side of the company spending the dollars or on the side of the consultant, or it could be literally the contract software developer, right? Mm-hmm. What I mean by that is the R&D will be able to be captured either by you, the company that's spending the money, or by whoever is working on your behalf to implement that project. So what we need to take a look at is, how is that agreement structured, and are you, quote unquote, releasing the R&D to your consultant in exchange for making that project what the tax code refers to as less risky? And that's a concept, to be honest with you, Howard, we probably would need another 25-minute show to explain in detail. But in simple terms, someone carries the risk associated with that work. If it's the consultant, then usually the majority of the R&D is on their side. If it's the business that's implementing that project, then the R&D would be on their side. So what happens, though, that does not take into effect the people internally in your organization that are working on that project either way. So at the end of the conversation, it really does become a ROI discussion, right? From a business perspective, does it make sense to spend time on a study? Because in any of these projects, there's going to be some R&D credit available. It just may not be enough to warrant a full-scale analysis. If you are looking at this, and I think that this is the beautiful thing that Howard said earlier, if you're looking at this prospectively and you're making decisions on how do we structure this project to ensure we maximize value, then that's the perfect time for us to help to ensure that the R&D will be on your side. Hopefully that.
Yeah, that is helpful. So one of the things I think I'm hearing is, think about this when you're doing a contract with an outside company that you're hiring, because I run a company that people hire to do this type of work all the time, and I have never And I can't tell you how many contracts I've read. I tell my wife all the time, reading and redlining contracts is by far the least favorite part of my job, by far. But
that's a surprise, Howard.
Yeah, I'm a creative guy. Okay, I just sit there, and they're always so damn long. I just did one yesterday, and it was 27 pages long. Indemnification and limitation of liability, insurance requirements. Like, oh my god, put a bullet in my brain. But in all that time, because despite disliking the activity, I do read them. I've never seen any mention of this. I've never in my life seen a client that said in their version, and it's always them sending me the contract, right? They send me their boilerplate. I've never seen any R&D tax credits, accrue to the client, et cetera. So it sounds like one of the things you're saying is that maybe that's something that the companies that are hiring outside companies should be putting in, is something about this, that if there's an R&D tax credit, who gets it?
Not language around specifically the R&D tax credit, but language around how they're being compensated for their work.
The risk.
Howard, let me ask you a question, if that's okay. Mm-hmm. Whenever a client comes to you and they say, hey, our internal rules state that there could be, a time and material discovery phase, but then you're going to have to quote us a fixed fee and you're going to have to stick to that model. Would you, as in your team, say, okay, that's fine, we can figure that out? Versus if a company came to you and said, Howard, look, we have no clue what we need, what we want. Let's just do this on a time and material basis. Would you take both projects? Would you lean one versus the other?
We do both. We do both.
Okay, and that's the response we get from every business that we work with. When it comes to what the client needs and wants, as a company, you tend to do what's going to make the project work and be attractive. That's the conversation that we need to have.
So you're saying that if
written physically, R&D tax credit goes to one or the other, it's that initial conversation about how you structure the agreement.
Got it. So if a company, like let's say I'm a bank and I'm hiring an outside company to create a website, if we do a time and materials project, in theory, the risk is on the technology vendor we've hired, and they would get the R&D tax credit, generally speaking. But if we pay them on a time and materials basis, then any overages would accrue to us, the bank, in which case we would potentially get the R&D tax credit. Have I got that right?
Yeah, it's not 100% that simple, but yes, wherever the risk lies, that's where the R&D is going to lean towards. But it's not an all or nothing concept. I think Michael mentioned this earlier. It could be half-half. It could be 80-20. Why?
Yeah.
Think about this.
Yeah, very interesting. Well, and when you say risk, in my book, I always have to plug my book. So in my book, Winning Digital Customers, The Antidote to Irrelevance, available wherever fine books are sold, there's a whole section on risk, project risk. And we define, I think, 10 types of risk. Technology failure, customers don't adopt it, legal risk, there's many types of risks. So is this very specifically in the law focused on the technology development risk? Or let's say I said as a retailer, I'm going to create this new app and I'm going to pay a fixed price to a company that's going to build it. But I have plenty of risk. I could pay that $1 million and this app might flop and I still have risk. Is that an argument you can make, or is that not? It's like, no, that's not the kind of risk the tax code is talking about.
I'm going to, again, kind of like you did earlier about the legal piece, right? We're not lawyers either. So I'm going to say that first, but I usually explain it as two things. It's risk of, from a monetary perspective, spending more money, and then risk of failure. Those two things exist. We should have a conversation.
Okay. Yeah, I mean, in my experience in digital transformation, there's plenty of risk to go around,
Oh, absolutely. But you have to do it. Otherwise, you're going to fall behind. Howard, I'm sure you pay attention to all of this as well. But in 5 years, every business will have to have some level of a digital platform in order to be operational.
Yeah.
Otherwise,
absolutely.
You're going to literally be left behind.
Yeah. Now, Alex, you mentioned resources outside of the United States. Is this tax credit limited? If I hire a company and they have a team in India that's building it, does it no longer apply because those resources are outside the United States?
It's a great question.
Yeah.
Michael, you want to?
So this is a domestic credit. So the work needs to be performed inside of the United States. So if you're hiring, like, say, a contractor and they're subbing out their work, or maybe even their employees are located in a different country, we would not be able to consider those employees for the credit. However, there is some work that is being done domestically. Maybe it's architecture. Maybe it's, designing the GUI. It truly depends. So we would be able to look at the folks that are domestic, but also, anything at that point, once it gets shipped offshore, that's where we would have to stop our investigation.
Right. So to your point earlier about thinking about prospectively, this is the kind of thing where you might think, well, I'm saving all kinds of money using resources outside the US. But and I've gathered this is partly why they are doing this tax credit. It's to motivate people to say, well, wait a minute, if I use resources here in the US, they may cost me more, but I'll at least get some of that back, or maybe all of it back. And so actually it might possibly cost me less.
Howard, the spirit and the intent, the congressional intent of this credit is to reward businesses with the idea that if Congress puts money back into American businesses and invests in them, those businesses in turn may invest back and reinvest that money back in hiring a person, or buying a new piece of equipment that keeps them relevant in the marketplace, or taking on a new project that might drive the economy forward.
Yeah, very interesting. Now, is there any limit to how much a given company can get? Is there a cap for one company in terms of how much of this tax credit they can claim? If they spend $1 billion, might they be able to get $1 billion tax credit?
That question's probably better for companies like Apple and Microsoft.
Yeah. But
no, there's no cap. And there's multiple versions of this, but it comes down to qualified dollars. If you have, if you are at the level of a business where there's millions of dollars in qualified expenditures, then you get a significantly larger credit. There's companies that take a $20,000 credit per year, and there are companies that take a $20 million credit per year. It just depends.
So you have clients that you're seeing, that you're working with, that are getting credits of millions and millions of dollars a year. Is that right?
Absolutely. Yeah. We're a company. We're about 1,200 people worldwide, I would say. So, we have companies of all sizes that we work with at this point.
And so let me ask this. It sounds like there's some interpretation involved in this, right? You have to sort of say, well, how much of this is really new? And it sounds like it's a little bit part art, part science in terms of figuring out, well, how much is a reasonable amount? Is it like you apply and someone in the government looks it over and says yes or no? Or is it more like the rest of your taxes where you just do it, you fill it out, you claim your credit, and then you either get audited and someone questions it, or no?
Yeah, this is, it's more of the latter. So this is a tax position that you're taking. And what our company, Alliant Group, does is we, again, qualify, quantify, and substantiate that credit, provide you with the documentation that backs that up. We're led by 3 former IRS commissioners. So the work that we do is to the letter of the law, but more importantly, it is defensible.
Yeah, slight adjustment. It's not an art thing. It's a black and white calculation at the end of the day.
Yeah.
So it definitely is technical and driven by various rules. So if you qualify, there's going to be a specific number that you qualify for, and you have to differentiate it. This is where the most of folks where we are brought in to rework or redo a study get in trouble, is they don't create the substantiation. They more of a estimated number or a guess.
Right.
And that's very dangerous because the rules change, and they change often. Not in a bad way. They are all conventions, but you have to take those rules into effect, which is, the having folks that were formerly at the IRS, were formerly congressmen, and helped to write some of these pieces of legislation is very helpful.
Yeah. That's great. Well, I can't believe we've already been talking for a half hour, because this is fascinating, and I could go on. I don't know if it's fascinating to everybody. I'm wondering. What's that?
Well done, sir. These are great questions.
Yeah.
Well, thank you. So I want to end with this. If you guys can explain how your firm works and how, like, if somebody said, okay, I want to not just learn more about your company, certainly let people know the URL and all that. If they want to contact you specifically for help in this area, we certainly want to give you a chance to plug your company, but also, like, how does working with a company like yours work? I'm assuming that someone would have to provide you with some stuff. You charge them to do some kind of, you keep calling it a study. Can you explain a little bit what you mean by a study and kind of how that works and how it works together or not together with whoever else is doing the rest of all their tax work?
Sure. So we partner with over 4,500 CPAs to make sure that our clients are confidently getting this on their tax returns. In fact, most of the time, proactively on behalf of their clients. But more importantly, how we work is very straightforward. We don't know that a project makes sense until we dive in. So we will, for every customer that comes to us, we will give a gratis assessment to. We want to make sure that this makes sense for them, because we would never advise you to do something that would either have a terrible ROI or may not show any benefit. So anytime a company would come to us, we'll talk to them, we'll get a fact pattern in place, we'll do a trending and benchmarking analysis to let them know, the potential of what they could be sitting on. And then we'll lay it all out for them, very straightforward, and see if this is something that they'd want to move forward with.
And then are there certain schedules of their tax return, and do you guys fill those out, or how is it mechanically, how does that wind up in their tax return?
Mechanically, we provide their CPA. So we will partner, we will loop in a CPA. We want them involved because their guidance is critical to our process. So in the end of our process, though, we will provide a CPA with everything that they need to get this on their client's final return.
Got it.
Decide if they would like, we'll actually review the return to make sure it's properly applied.
Mm-hmm. Mm-hmm. And would you have I got the right idea that if I was the chief marketing officer of a company and I was trying to get to pitch and say, I want this company to invest $10 million in building a new app or whatever, that they could talk to you and you guys could help advise on how much of that seems like it would be eligible for a tax credit, but potentially give them the information to be able to go in and say, hey, I want to propose we spend $10 million on this app, but $7 million of it should be a tax credit. So it's really only going to cost us $3 million. Have I got the right idea about that in terms of how you could work with somebody?
The idea is good. The magnitude of the example probably doesn't work out exactly like that, but sure, we can look at that up front and suggest what that could yield in terms of value on the back end, for sure.
And just so I'm clear, the magnitude meaning, because in my example, it was like 70%, and usually it wouldn't be that high a percentage. If it was 10 million, it might be more like a $3 million tax credit.
Sure. Yeah, exactly.
Still substantial,
I can tell you it's not going to be a 7 million on a $10 million.
Right. Well, originally you said it could be 0, it could be 100. So I'm thinking, how do I get to the 100?
Yeah, and that's very fair. But there's a multiplier that we have to take into effect. What I meant 0 to 100 is 100% of your spend could qualify as research expenditures, but that's a calculation that happens.
Sure, understood.
Getting a portion of that as an actual credit.
Great. Well, thank you so much. And while my company hasn't really engaged yet, we are in active conversations with this company, the Alliant Group. Michael reached out to me on LinkedIn, and he said, I think I can save you money on your taxes. And I said, tell me more. And so they're doing a preliminary analysis for my company because, hey, who doesn't want to save money on their taxes as we approach the day when we have to write a big check? So probably too late for me for this April 15th. But one thing you told me, Michael, that I want to also make sure people realize is that you can go back, I think you said 3 years. Is that right?
Yeah, so you can go back 3 years. This is the power of this credit. You can go back 3 open tax years to statute years, right? So you could theoretically go back to 17 to help generate this credit. And as you can imagine, it adds up pretty quickly when you can. So that's, it would seem to me like if you're working with a company that hasn't been doing this and you're doing any kind of development or things like that, you should be looking into this probably. Knowing that April 15th is tomorrow, it also makes me ask the question, since you can go back 3 years, when is it now too late to go back to 17 and we've crossed the threshold when you can only go back to 18? Is that tomorrow? So for C Corps, it is tomorrow, unfortunately. But the beautiful part about this extension to May 17th is the statutes were extended to May 17th as well. So if we could have a conversation before then, we would be able to capture that 17 years still.
And if you get an extension on your taxes, does that also extend this to like October or not necessarily?
Yes, it does.
It would. Yep.
Okay, good. So that's easy to get. So
it would default to the date that you actually filed that return. Again, great question, Howard.
Yep.
Got it. All right, great. Well, this has been fascinating. I'm excited about, I'm thinking ka-ching, and hopefully that will work out for us. And hopefully there's many people listening for whom this is either something that can get them some money that maybe they didn't know about from the past, or help them make an even stronger argument for investment for things in the future. So I thank you guys for being here. Let me ask you to please tell everybody, if they want to learn more about you guys or your company or connect with you, where should they go? What should they do?
They should go to alliantgroup.com just to understand a little bit more about our business, about the industries that we cover, or they could call me or email me directly. I'm sure this will be posted on multiple platforms, so LinkedIn works very well. I love getting LinkedIn with people. Also, phone call, 212-613-4536.
All right. Well, thank you so much for being here, guys. This has been fascinating. I'm sure we'll be talking again in the future. If anyone has questions for you guys, you can send them to, there's Michael's email address right up on screen. And hopefully we got that right.
Yeah, that's it.
But you can also post questions right in the chat here. If you want to put questions in the thank you page, she's saying that you rock. You guys rock.
I appreciate it.
And if you post questions in YouTube or LinkedIn or Facebook, we will make sure that they get forwarded to these guys if they're, texts. Or if you have questions, you can also post them there. We'll make sure they get your questions. So thanks, everybody. As always, thank you all for listening, for watching, for joining me again on the Winning Digital Customer Show. Thank you to my guests, and I look forward to seeing everybody next time. Have a great tax day.